Shopify stock has been hit hard since Liberation Day and the announcement of global tariffs. On April 2nd, the stock closed at more than $144 on the TSX. On Tuesday, it closed at over $118. That's a decline of more than 18% within the span of just 3 weeks. But the big question is, could things get worse for the stock from here on out? Or is it worth buying on weakness right now? Shopify's platform makes it easy for people all over the world to sell just about anything and everything online. It's been the more convenient option for merchants who don't want to sell on a marketplace and want to still be able to manage their own websites and draw traffic there, rather than to an eBay or Amazon site. Shopify makes all that possible. And one thing Shopify merchants often do is use drop shipping. But what is drop shipping? It's a retail model where the seller doesn't keep any inventory. Instead, when you buy something from a drop shipping store, that order gets passed along to a third-party supplier, usually overseas, who then ships the product directly to you. The seller never sees or touches the item. Their main job is running the storefront, handling marketing, and managing customer service. It's a popular model because the upfront costs are low and you don't need a warehouse or logistics setup to get started. But the model also has its downsides. Since sellers rely heavily on suppliers, often based in China, they're vulnerable to shipping delays, quality issues, and more recently, trade regulations. Most dropshippers work with thin profit margins, so even small changes in tariffs, shipping costs, or refund rates can be a big deal. That's why the current trade war between the US and China is so problematic for many Shopify merchants who rely on dropshipping. It can destroy their business models. Starting May 2nd, the US is scrapping the de minimis exemption. That loophole, which allowed duty-free imports for goods under $800, was a key pillar in the dropshipping economy. Now it's going to be gone. What does that mean for Shopify sellers? In short, higher costs, more delays, and thinner margins, if any at all. Tariffs could hit up to 30% or $50 per item. We're already seeing the fallout. Small Shopify merchants are reporting revenue drops of 30% or more. Shipments are getting stuck at ports, and while Shopify doesn't handle logistics directly, its business depends heavily on these merchants staying alive and thriving. If there's more business on its platform, that means more fees for Shopify to collect and more revenue that it generates. But if that dries up, then Shopify suffers right along with its merchants. And with the US being a major customer of Chinese goods and cheap products, it's not as if Shopify merchants can adapt easily. There's no denying their sales and profits will take a hit. For now, Shopify is still doing well. In Q4, its revenue is up 31%. Management's guidance for 2025 called for mid 20% growth. But the problem is that was before the news around global tariffs dropped. When the company reports earnings for Q1, there may very well be an updated and significantly reduced guidance. There's a strong likelihood that Shopify's growth rate will slow drastically. And if it was projecting 20% growth, I wouldn't be surprised if that falls down to the single digits given how catastrophic tariffs and a trade war involving China and the US may be. It's hard to understate the impact as the stock has been falling sharply and we still don't even know the full effects. But one thing's for sure is that things can get much worse. Many countries could fall into recessions. Shopify stock has already been nosediving, and recently its 20-day moving average fell below its 200-day moving average, which is a bearish sign, and it could trigger more of a sell-off. A lot is going to hinge on what happens in its upcoming earnings call, which will happen in early May. A poor guidance could cripple the stock, especially when you consider its valuation. Shopify stock was doing well heading into this year. It rose nearly 50% in 2024. And although it has given back some of those gains, it's still trading at around 50 times its trailing earnings. That's a steep multiple for a company that's growing at a fast rate. And it looks even more expensive when you consider that Shopify's growth rate may slow down significantly in future quarters. Is it all doom and gloom for Shopify, or can a bullish case be made here? Shopify still has a powerful platform. It's been expanding and been able to not only coexist with Amazon, but also partner with it. It's expanding in an enterprise, rolling out more tools for larger clients, including AI capabilities, and building a more diversified revenue base. There's definitely some risk ahead for the company. Personally, however, I wouldn't buy it right now just because I fully expect it to drop much lower as the year goes on. The situation between the US and China doesn't look to be improving anytime soon. While tariffs may be lifted or paused for other countries, it seems that China is who the US is going after primarily with its new policies. And if Shopify stock tanks on these developments, it could drop to bargain levels. Could it fall to around $40 that it was at in 2022? Perhaps if tariffs don't go away and a recession hits in Canada and the US, that could be a distinct possibility. But even if it falls to around $60, like where it was a couple of years ago, that could make for a great price to buy it at. I still like Shopify as a long-term investment, but I don't think the sell-off is over just yet. It doesn't scream bargain at its current price, and I'd wait for more of a drop before considering buying it.